June has been an excellent month on the stock market, but is July going to follow the same trend, or will the news of a future hike of the interest rates will slow down the growth? Well, today I'll share with you two great stocks that are currently at discount and that can provide you some great potential of upside over the next couple of months. And so you'll find in this video what are the best stocks that you can buy right now in July 2023. So without further ado, let's take a look at my pick number 1. For the first stock on my list, I've decided to plunge into a sector that has seen some massive downtrend over the last couple of months, but that could see some great switch in their momentum lately, notably with the OPEC decisions to cut the oil production. And so I've decided to pick the company Suncor with the ticker SU. Indeed, since the beginning of the year, we've seen some massive downtrend for all the kinds of energy companies, and more precisely for the different oil companies, which was mainly due to the drop of the oil price. In fact, the characteristic of oil is that it will tend to follow the inflation. It means that during periods such as between 2020 and 2022, where we've seen that the inflation was going through the roof, obviously the price of oil has also been following this trend. But lately, with the strategy of the Fed and the Bank of Canada to increase the interest rates to slow down the inflation, this has obviously had a pretty negative impact on the value of these kind of companies. So keep in mind that as long as the Fed and the Bank of Canada might continue to increase the interest rates, as long as these kind of companies might continue to drop and lose some value, as we've seen with Suncor that has lost about 20% of its total value since the beginning of the year. But since the inflation is getting more and more under control compared to what it was last year, well, it means that they might be able to stop increasing the rates pretty soon, as it is predicted to see some stop in the increase in 2024. In any case, this Canadian energy company located in Calgary is one of the largest energy and gas companies in the whole country. Indeed, with a current market cap of about $50 billion and some revenue in 2022 of about $45 billion, it is definitely an important actor in the field. Plus, with the global environmental switch that will happen over the next couple of decades, this company has already started to adapt its business model to tomorrow's environment. Obviously, the majority of their income still comes from the oil production from the oil sands in the west of Canada, but they also have multiple types of overseas assets, notably in the United Kingdom, great refineries that give them the opportunity to transform petroleum towards products that will after be sold, and over 1,800 wholesale and retail shops in Canada that can be found under the name Petro-Canada. Plus, as I told you earlier, since 2006, they have started to adapt to tomorrow's problem in terms of the environmental crisis that is going on right now, and they've become the largest ethanol plants producer over here in Canada. Indeed, they are producing over 400 million liters of ethanol annually, and the ethanol is actually a renewable energy that is fueled by many kinds of plants that are considered as biomass. In their case, they are using about 40 million bushels of corn every single year to produce this energy, and in fact, this represents an astonishing number of about 20% of the total corn production in Ontario. Add to this, more recently, they have acquired Total Energy for about $5.5 billion, which will give them more access to oil sand assets. This represents an excellent news, notably for the Suncor investors and for the people that are interested to invest in Suncor. Plus, what makes this investment very interesting at the moment is their super low price to earnings ratio of only about 6 at the moment, which is showing that this stock would currently be undervalued. And add to this, over the last 12 months, you can see that they've been able to achieve some incredible profit and operating margin, as well as an excellent return equity of about 20% for the different investors. And despite having reached close to $56 billion of revenue over the last year, this company has seen some decrease in the total growth of their total earnings and revenue over the last quarter. Nevertheless, they are still able to provide close to 5% of annual dividend to their shareholders with a super low payout ratio of only about 30%, which is showing that on the long term, this dividend is quite sustainable. However, as you can see by the huge difference that exists between the total cash that they have and the total debt that they own, well, this company will still be massively impacted with a future hike of the interest rate, as we can see by its beta of over 1. And now for the second stock on my list, I've decided to include one of the most undervalued tech companies at the moment, which is Google with the ticker GOOG. This company might need no introduction for most people, but if you were living under a rock for the last couple of decades, Google is currently one of the largest companies in terms of valuation in the world, with a current market cap of over $1.5 trillion and some total revenue in 2022 of over $200 billion. This business is currently well known by many people that are using the internet, and more precisely by you that are currently watching this video, because right now Google currently has the world's largest search engine by far, with over 85% of the total market, and they also have a great variety of products and services going from Android to Gmail to Google Drive to Google Maps and also to YouTube. And so, as you might be able to understand, they are making the largest chunks of their total earnings from the different advertisements that they'll be putting on their different websites and products. For example, a certain company could decide to advertise certain of their products and services on a website such as YouTube. And so in exchange of the publicity that they'll receive, they will obviously give a certain amount of money to Google. And lately, just like its technology competitors, Google has started to develop its own AI, which is called PaLM 2. And this AI is notably a pro in advanced reasoning tasks, which include code and math, classification, and question answering, as well as translation. And so this was a quite strategic and smart move by Google, because by having the largest search engine in the world, it means that on a certain way they have a certain monopoly on the internet field. But with the advance of other great technologies such as ChatGPT, it will obviously make them some competition in the AI field. And by creating their own AI structure, it means that they will be able to stay at the forefront of this technology sector. Plus, lately, Google has been trying to expand the scope of the operation, notably by going in different countries that don't necessarily have great access to internet. For example, recently, Google's CEO has confirmed a $10 billion transaction to India Digitalization Fund, which will help them to open a fintech operation center in a country that should see some massive growth over the next century. All of this makes that Google is currently a pretty wise choice for every growth investors that are looking for great capital appreciation over time, because with a current price to earnings ratio of about 27 at the moment, it is definitely one of the most undervalued tech companies on that side. Plus, this business has also been able to achieve some incredible profit and operating margin over the last year, combined with some great return on equity of over 22% for the shareholders of Google. And despite not giving any dividend compared to Suncor, this company is keeping all its total earnings to try to grow as much as possible this company, as we can see with its total capital appreciation of over 40% since the beginning of the year. And one of the big advantages of this kind of company is that it won't get directly hit by the hike of the interest rate, because they don't have personally a lot of debt compared to their current cash position, but in fact they might get indirectly impacted by the hikes of the interest rate, since their clients might have a lower budget to invest in advertisement. So there you have it. Those are two great stocks that you can have on your watch list for the best stocks to buy in July 2023. But on your side, if you want to reduce your total risk in your portfolio and invest directly in a basket of stocks in the form of ETFs, well, to see what are the best ETFs that you can buy right now in 2023, check out the video that's going to be right over here, and I will see you soon. Peace!